Our opening quote this week reminds us that profits come from systematically weighing the evidence the market provides and investing accordingly. This week, the NASDAQ, Dow, S&P, and Russell 2000 continued to make new highs. Naturally, the media has begun trumpeting "winter is coming" type headlines, asking if this is the top, if we've seen peak economic growth, and if a recession is right around the corner. Each bull market contains the seeds of the next bear market, and all of these fears will eventually be realized at some point in the future. But should we invest against the market tide today? We'll review the facts and evidence to answer some of these questions. We'll also look at how the facts, like the statement, "winter is coming," are sometimes misapplied. First, we'll look at a summary of this week's economic data and interpretation. This week's economic data continued to show record economic strength. Consumer confidence is the highest since November of 2000. Strong consumer spending was reflected in the highest GDP number in 4 years. Inflation remains tame, and job growth continues at levels not seen since the 1960s. Housing remains a weak spot, but prices are beginning to come down, and there is so much demand that a crash is less likely than prices coming in line with wages. Overall, data on the strength of the economy keeps hitting record levels. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, stocks rose on news of a trade deal between the U.S. and Mexico. On Tuesday, the market rose slightly as it turned its attention to the prospects of a deal with Canada and longer-term implications for a deal with China. On Wednesday, second quarter profits showed the highest year-over-year gain in 6 years. On Thursday, stocks sold off on news that President Trump planned to move forward with $200 billion in tariffs on China. On Friday, the market treaded water, waiting for the outcome of negotiations between the U.S. and Canada on trade talks. The market rose slightly on end-of-day news that talks would continue into next week. During the week, the Dow, S&P, NASDAQ, and Russell 2000 all reached new highs. For the week, we closed up 1.06%, and the month and year-to-date statistics are provided at lower right. Now we'll turn our attention to the ever-popular gloom and doom that winter is coming. The media loves to bring on the bears when the markets make new highs. Being a bearish commentator makes you sound smart, unless you're permanently bearish and people look at your track record. There's a saying that a broken clock is right twice a day. And here's a chart by John Borman showing some famously broken clocks, who call for tops over and over again as the markets went higher and higher. I recommend that you pause the video here and take a moment to read these fear-inspiring quotes. Think about the gains you would have missed in your portfolio if you had acted on these crash calls instead of using an evidence-based, systematic approach. The next most popular topic is issues that might derail the market. Here's a nice graphic from Nomura with 60 issues that could sink the stock market. This allows you to worry endlessly. Think of it as an endless financial media headline generator. Could Fed hikes tip us into recession? Could midterm elections derail the market? You could fill in the blank 60 times with these concerns. When these are gone, more will take their place. Remember, the market climbs a wall of worry. Could one of these issues sink the market? The answer, as always, is yes. Are we saying that you shouldn't be informed? No. But it's not possible for one person to know how all or even a slim majority of these issues will play out. But as we'll see, millions and millions of people buying and selling in the market are able to fairly accurately determine probabilities which are reflected in price. This means that when winter finally does come, whatever the issue, we'll see it in the evidence on the charts. So let's look at a better way to think about risks in the seeds of recession. As soon as spring has arrived, the statement that winter is coming is factually true. A faulty application of this fact would be wearing a heavy coat on our summer trip to the beach. Wearing a winter coat to the beach would be an opportunity cost that would reduce the benefits of going to the beach. In our portfolios, this opportunity cost comes from owning too many defensive assets or jumping in and out of the market as conditions improve. We have to remember that the start of every bull market contains the seeds of the next recession. The question is timing. We can also look at the evidence on the charts to determine the probabilities that the bull market will continue for a long time. In the next several slides, we'll quickly look at 3 fears that are being extensively covered in financial media that will eventually materialize: recession, economic slowdown, and inversion of the yield curve. Our job is to systematically look at the current evidence and determine probabilities. Whether you're considering fundamentals or technicals, or both, price reflects the net bullish or bearish opinion of millions and millions of market participants on every concern facing the market. This slide is from our May 11th video, and some of the concerns have changed, but the way the market discounts the issues is the same. This is why we focus on price. We cover this market mechanism in detail in this video that you can find on the Caliber Capital Management YouTube channel. This is a log scale chart of the S&P 500. We'll start with a look at recessions going back to 1927. Recessions are shaded in gray, and you see our familiar periods of long-term consolidation shown in the gold boxes. A popular headline is that we haven't had a recession in a while and we're overdue. This is usually followed by the question, could X, insert concern here, cause the next recession? Just because we haven't had a recession since 2008 doesn't mean the probability of a recession has gotten higher. The probability of heads or tails on a coin toss is 50-50, regardless of the previous coin tosses. The frequency of recessions has been going down since 1854. To determine the probability of a recession, we'd have to look at potential causes. Economic slowdown is a very accurate recession predictor, often 3 to 15 months in advance. This slide is from Advisor Perspectives and shows the leading economic indicators going back to 1959. Notice that we've surpassed the last pre-2008 high in terms of the health of the economy. An inset at lower right shows the past 12 months, and the trend is steadily upward. On our Twitter account, which you can find in the lower left-hand corner of this slide, we post a dashboard of these indicators every month and include the rate of change shown at left. Just like the stock market, the rate of change does not move up in a straight line. Successive declining data points and ultimately across into negative territory provides more advance warning of a coming recession. We would begin to see a decline in the graph at upper right. Does the graph at upper right show a decline in the leading economic indicators? The answer is no, nor does the ratio shown at lower right. We can worry that eventually the economy will slow down if we want to, but the evidence shows that it hasn't yet. Let's look at the yield curve. This chart looks complicated, but it's not. The Fed recently published a study showing that the spread between the 10 and 3-month Treasury yields was more predictive of recessions than the traditional spread between the 10 and 2-year yields. So we'll be looking at the 10 and 3-month curve. The black line is the yield curve, which is the difference in yields between the 10 and 3-month Treasuries. The green line is the S&P 500. When the black line drops below the red line, the yield curve is inverted. Yield curve inversions have a very strong track record of predicting recessions shown in gray. Most of the time we get 1 to 2 years from inversion to recession. The yield curve is not inverted yet. Is it preordained that it will invert? No. If it does, it will take some time to invert. Looking at 1995 through 2000, a flattening yield curve doesn't have to be bad for the stock market. During this period, the S&P increased by 223%. As the yield curve is flattening again, the market has increased 50% so far. The chance of another rate hike priced into the market for September currently stands at 93%. With regard to further rate increases, the Fed is very conscious of the implications of inverting the curve, and we'll see evidence of that in the next slide. This chart is from Bespoke and reinforces the statement that the Fed doesn't want to invert the yield curve. Look at the dark blue line, which reflects hawkishness or a desire to raise rates and dovishness or a desire to be accommodated with rates as expressed in Fed speeches. We see a change here to a more dovish tone. If you remember the Nomura slide with 60 concerns that could sink the stock market, there are many issues we could examine. Instead, since the net aggregate bullish or bearish estimate of probable outcomes is reflected in price, let's turn our attention to technical evidence. Ed Sequoia is a famous trend-following investor who places importance on the long-term trend, the current chart pattern, and good places to buy and sell. He also observes from experience that a market composed of millions and millions of buyers and sellers cares very little about our fundamental opinions about what may or may not happen. So in the next few slides, we'll quickly review the technical evidence for the long-term bullish trend. Remember that the opinions in this video are suitable for our investment time horizon, strategy, and risk tolerance, and there's no way for us to state suitability for any viewer. As with any information you encounter, you should consult with a professional financial advisor before undertaking any investment decisions. Let's look at breadth to determine whether or not the rally is being driven by just a few stocks. The Value Line Geometric Index is a geometrically weighted index which tracks the median movement of stocks. Is price too high, or is this the start of a new long-term bullish trend with support fairly close by? As you can see, the Value Line Geometric Index consolidated from 1983 when price entered the box and was not able to successfully clear the top of the box until late 2016. This is a 34-year consolidation that the average stock only broke out of 2 years ago. This shows that the rally is broad-based, and more important, the longer the period of sideways movement, the longer the advance out of the consolidation. The Vanguard Total Stock Market ETF also made a new high. This chart shows the S&P with the solid line, and the dotted line is the advanced decline line, which measures advancing to declining stocks. As you can see, the advanced decline line has also made a new high. Last, we'll look at our visual trend of the S&P, which you're very familiar with as a regular viewer. You can see that after the 2015-2016 consolidation, the bullish trend resumes. We consolidate again through August of 2018, and have only just now broken above the consolidation. Since the correction in 2015-2016, the moving averages have been bullish. The moving averages compressed some in 2018 due to the effects of the correction, and are now recovering. The 50-week moving average shown in pink is a good approximation for the 200-day and indicates a strong bullish trend. Remember, the signals we've just covered are very long-term in nature and are suited to our time horizon. Will we see normal red and green days in the short term? Absolutely. Could we pull back and test the top of the consolidation box? This would not be uncommon, and it's happened many, many times before. But our focus is on the long-term trend. And all we've done in this presentation is simply review the evidence and facts with no predictions or opinions. The historical patterns, the facts, and the evidence show a much higher probability that this is simply a resumption of the bullish trend rather than a top that we're about to crash from. August is now in the books. The NASDAQ had the highest percentage return in 18 years. The Dow, the S&P, and the Russell 2000 all hit new highs. With Labor Day weekend upon us, summer is drawing to a close. And if you're taking one last trip to the beach, ponder Ed Sequoia's observation about the futility of pushing against the waves and that the market is always right. Is winter coming? It always is. But the question again is timing. We can answer the question by simply observing the evidence in economic data and on the charts. Ignoring the evidence all around you is an opportunity cost that reduces your investment returns. This means losing money that could have been earned by being properly invested for the current market conditions. Maintaining overly defensive asset allocations in a very bullish environment is a lot like wearing a winter coat on a summer trip to the beach. Instead, it might be better to develop a systematic approach to chart the seasons of the market, invest, and dress accordingly. I hope you find these videos useful. I'd like to thank every one of my viewers for watching, and I wish all of you a very happy Labor Day weekend. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.